Oh, is that what's up, Greg? You bought a little Antilia? Did you buy Liquidia? I had a 5-bagger in Liquidia before the Antilia. Disappointing. Roche went hostile after Illumina way back when, and I think they did another hostile. They also, I think they dropped a hostile on Genentech. That's how they got Genentech. Yeah, you're doing great, Alejandro. You're next Buffett. Is IonQ flat for the year yet? Let me check. How's IonQ doing? Still down 20%. You got $8 more there, Alejandro. 42 will be flat for the year. I went long Palantir if you may recall, because I was short HIMS. I figured if HIMS can rally 20% on a so-so quarter, why couldn't Palantir? Trades sort of worked. I'm kind of neutral on Novo. I liked it. I bought some. I sold it for a little profit, and I don't think you should touch it. Ozempic is slowing rapidly. No, Mac, you're looking at a very irrational market environment. D-Wave been talking about selling this computer to these guys for 4 months. I have the time to explain to you why strategy isn't a Ponzi scheme. You know, it's not the same thing as shorting Bitcoin, right? You could short strategy and buy Bitcoin. The face ripper. They'll happen. It'll happen here and there. The faces will be ripped. Yeah, I mean, look, in a lot of ways, leverage is just greed, and Bitcoin, I mean, MicroStrategy is just leverage. I mean, why not just have dollar for dollar coverage of Bitcoin? It's surprising how well they did. You know, obviously, as you know, they got bought out. But yeah, that is, I think, one of the bigger values of Bloomberg is you get a little bit of that data, you get a Rolodex. The actual market data is not even, that relevant. I can look up every guy at Apollo or every guy at Cerberus or whatever. Phone number's right there. I can message them. The Preqin obviously sometimes gives you returns, but Preqin sold for $3 billion, and that was kind of probably generous for what it is. I think this new idea of quote unquote order flow is very cringe. I think somebody just made it up, and it really doesn't make any sense. Now, there's a real thing called order flow on Wall Street. That's when a trading desk advertises they have a buyer or seller. That's totally different. But you don't get order flow on level 1 or level 2. Sarepta is going to be in the doghouse for a while. I mean, it's just one of these things where people are sick of this company for a little while until they start proving themselves. Yeah, Palantir is going to go right back. It's basically just a PR campaign. I mean, they're going to say that the UK bent the knee, but what actually happens in the trenches, who knows? Well, the question is, what the IR guys, I'm not sure they get that much value out of it. There have been a lot of attempts to make the hedge fund database and the private equity database and so forth. And, Preqin's obviously kind of done the best, but, what is the real value add? Finding LPs? I see. Well, you can get benchmarks. Yeah, I mean, they don't have every fund, right? So in the hedge fund world, they have like 5% of the returns, if that. And then on the VC world, they have maybe 20 or 30%. So I don't know, you tell me what they have on the credit side, but even in PE, well, I think the PE returns are a little easier to get. They certainly don't have like really good returns. I have a little bit of a special mousetrap that I think could work for that. But regardless, very few people have anything on the hedge fund world. But perhaps they have it for credit funds. But even still, you ultimately, I don't see how you can get. I start a credit fund I have 5 LPs. You're not getting my returns. Period. So the LPs know what the benchmarks are. Yeah, I mean, undercutting seldom sells software, from what I know about software. You typically need to, add something, and I think more coverage would do it. For whatever, somehow, some way, over the last few years, that's become a thing to trick retail investors. You'd be surprised. I mean, people don't easily switch things for price when they're used to something and so forth. None of it's a thing. Nothing has changed in the stock market in the last 30 years that would make those products make sense now and not make sense 10 or 20 years ago. That's how you know they don't make sense. What has changed from a market structure or disclosure perspective makes those volume footprint things make sense. Nobody used them 10 years ago, 20 years ago, 30 years ago. There's no new disclosure. You can't find out what somebody's positions are. It's just not possible.
Yeah, we got a lot of good biotech shorts. Some of them started to play out like Capricor, Anavex, Celis.
Well, let's say somebody puts up 100,000 share trade. What do you learn? How do you learn anything from that? Do you know if they're done? Do you know if they have more stock? Do they know if they have less stock? What does it tell you? What's actually okay? I was fighting ChatGPT on this order flow. I finally got it to agree I'm right. It said, oh no, you know, this is level 2 data and tick level data. I was like, what? That stuff's been around for retail even for 20 years. You're exactly right. Level 2 and time of sales data have been existent and widely available for decades. Why the sudden surge in tools specifically packaged as volume footprint or order flow? This software primarily represents a repackaging of level 2 and time and sales in visual format that appears as novel and attractive.
This is where the phantom shares are.
I mean, the best way to manage it, Mark, is to cut your risk as your P&L drops. You know, my P&L was fine, and it would have been perfectly fine as well if I just held the short. But the way I looked at it was news was negative. The company distinctly has this extremely disappointing number on backlog, and I've reasoned that the rise in the stock price would be temporary. Not only was it not temporary, basically, you know, it was up 20% when I shorted it. It basically went up another 20 or so percent. And again, I don't understand the interpretation of the quarter. I mean, you listened to the conference call. It was absurd. Yeah, you can certainly try to hedge. I think that one of the problems with hedging these very volatile stocks is you got to pay through the nose for premium or premia. But, you know, it happens. I mean, just have to fight. I'm probably going to add more capital. But part of it is I don't want to add more capital to this account, partially because the people at 𝗬𝗏, like they really don't let you short the way like Interactive does. Well, the idea of an auction failure is that there's always going to be one side that outnumbers the other. And that's as a price moves and then the price moves in an opposite direction. Concept is that when it reached that turning point, it's because the one side overwhelmed the other. And that if one side overwhelmed the other at that turning point, it's also increasingly likely that one side is going to continue to overwhelm the other for the foreseeable future until, you know, there's some change in behavior. But, you know, having said that's again a tautology, and if you fractalize that, you know, it applies at every scale. It would apply at the microsecond scale, which doesn't make much sense. Yeah, markets aren't really auctions, but if you think about them as auctions, what you read is it's not a wasted education at all. It's just a book. Didn't take you a lifetime, right? What I would say is, like, I would read the academic journals. And if you want to start, like, you really want to be a pro at this kind of stuff, you know, there's both AQR and D. Shaw have printed white papers, which are not the same thing, obviously, as published papers. Let's see here, research. Some of these, again, are more white papers than research, but let's see. I like this. I mean, I don't know if they still, I'm sure they still publish. But yeah, I think some academic literature will get you further in understanding markets. I think that a lot of traders who are really good at trading, there's not actually a methodology that they have. A lot of it's pretty all over the place. Is alpha just beta waiting to be discovered? You know, I'm thinking of some of the papers they wrote really long time ago. Non-cap weighted indices, market neutral investing, 1998 paper. These aren't necessarily in order either. Yeah, I did, Michael. I agree with it. There are some services like that, but generally, like the academic world, you're right, is a little bit of a different. Okay, so D. Shaw research is different from D. Shaw's published research. They have like a drug company. These guys used to do some interesting publishing too. A lot of guys have scrubbed their stuff. I think the simplest answer why there's no like concrete theory of near-term investing or trading is that if there were, it could be very easily systematically kind of created. I think the reason I believe in market making is, you know, you're providing a trade-off, and the trade-off makes sense. So, you know, for something to be exploitable, there has to be a pro to it and a con to it. Because if it's only exploitable, then it shouldn't make sense. It shouldn't exist. Academics want to get noticed.
There's a really good software called what is it called?
It starts with a Z. It's a plugin, 𝗁𝗏. But none of those are going to be the high touch service that I think Quants want or some other hedge funds want. Yeah, I'm not spending too much time reading papers these days, but I think 𝗁𝗏 is a great way to organize your academic research if you have it. What's better about IB? What is investment banking?
Their secret is public-ish, and their returns have dropped a little bit. I'd say we're halfway there already, Joseph.
It's not the secret got leaked. It's that many people are doing it, I think. There's only so many quant strategies, too. I think their secret is leverage, to be honest. Yeah, banks do it, too. Look up most of the banks' income statements. Goldman and all these guys, and you see how much money they make market making. Trust me, when these guys started their firms, they didn't have the 500 PhDs. Those guys have not, the 500 PhDs don't actually add much value to the firm. They look good. The same core structures is still there. Not a whole lot changes. Every firm's a little bit different, but most of the firms are a mix of market makers, trend followers, factor investors, kind of linear combination investors, and then more hard arbitrage like index arb and so forth, ETF arb. I don't think the alpha's gone, but I think it's a question of how much leverage do you want to take? Because yeah, different firms have a different tolerance for like magnifying returns, and different banks have a different tolerance as well for how much exposure they'll let you take. That's why Renaissance did the basket options. And basket options were, a pretty big part of their returns. If you can get good leverage and good terms, that's, your return has to be higher than the cost of the leverage. There was tax reasons and leverage reasons. Remember, they're a domestic fund, mostly a domestic fund for a long time. LTCM wasn't a money printer, but back to sort of the point, Renaissance took a lot of leverage, and I think at least two times publicly almost had a run that would shut them down. You might have a Sharp that's modest, but if you're willing to leverage it, you could still get a pretty nice absolute return. I mean, imagine if I told you can make 5%. I'm trying to find my mouse here. I guess if I told you can make 5% a month. That's the mean. But the sigma is not a great representation of risk. So let's say the variability is, say, 2%. We say, I'll take this, or let's think about it as choice A. Let me give you choice B is maybe more important. It's a 1% monthly return, but the commensurate ratio, so it's at 0.4% variability. This is not that outstanding, right? So let's say you levered this to that, or even levered this even further. The sigma is not, even that important of a metric. I can even lower this to like 0.1%. The problem isn't the standard deviation. The problem is that you have to sort of balance it over a distribution of returns. And the distribution has a lot of properties. It's not just sigma. It's also, so let's say these are readings. What are we saying? Most of these readings cluster around one, right? One sigma. So let's argue this is kind of what we see. They even shouldn't be on XY axes, but let's say this is what you see. And then you have one big fat, guy here that you haven't seen yet, but he's lurking. This is kind of the problem with this model. You're just going to think this is like reasonably well behaved kind of, but you just don't have enough observations. And even if you do, the actual governing dynamic or first principle of the market could still be something that evolves. For example, the amount of quantitative market participants has grown dramatically. The amount of people in the same trades has grown dramatically. So what a lot of these funds don't want to do is lever this up to this or higher. I think there are some firms willing to do that because a 20% drawdown or something like that, even a 30% drawdown is tolerable because let's say you don't have outside capital. Let's say you're a true market maker or proprietary market maker, kind of no hedge fund, no limited partners, just you and your boys, which was the way Susquehanna worked and the way Jane Street worked and all this stuff. Then you might say, well, we can survive 30%. You know, in the hedge fund world, you'd say, I can't survive 30%, although some people certainly try. The limited partners will want their money back because I've advertised that I'm a systematic investor that will never go wrong. So you might say, I'll take this and maybe, I don't know, 2x lever it or something like that. So anyway, it's there's a, and you might want, you know, different strategies that sort of take this and do different things with it, or, you know, you have strategies that will actually perform differently when this strategy is doing well. Maybe there's a strategy that is really non-correlated that you can also apply. So they have stop losses too, but you know, I think that some of these models, most of these models are mean reverting models. Market makers by definition mean reverter. So spreads will blow out and statistical observations will seem rare, and you bet on the spread closing and the spread gets wider and wider. And the nice thing about not having as much leverage is you can ride it out. But if you have a lot of leverage, you could be down 20 or 30% pretty fast, because some of those returns are actually, those are all levered already, right? The market maker algo that I run sometimes is like 3-to-1 levered already. So leveraging that more to get your target return. Let's say you say, I want to be like Medallion, I want an 80% return. Cool, you can do that with anything. You could take your biotech book that you think is going to make 20% this year, 4x lever it. The problem is that you're not as consistent as Medallion, right? A bad month for them is like flat to down small. Bad month for you or me, if you lever that 4x, you'd be out of business. So, or close to it. So you got to find something that's so consistent. And if it's so consistent, it's probably not a big effect, right? It's like just like medicine. You know, you might be getting, like I said, 50 basis points, 1%, but it's consistent. And that you take up and lever up. And yeah, it's a more risk averse because of the 3,000 or so positions you have, which provide a bit of a buffer. But the problem is that buffer can be illusory when everyone has the same 3,000 positions on, because everyone has the same trade on. It's not a great, you know, the different carry trades and their different configurations tend to blow people up. You know, FXCM blew up on the Swiss franc because the Swiss franc never had a 10% move in a day ever, I think. It had a 10% move. The Swiss bank said that they wouldn't peg it or something like that. And then somebody blew up, I think FXCM, some other firms, and it retraced immediately. So, you know, no matter how comfortable you feel that your mean reversion will work, it might not. When 𝗏𝗏 happened, you know, and 𝗏𝗏𝗏𝗏 Capital blew up and almost took Renaissance down with it and other firms, Merck and Pfizer and J&J, like drug stocks I was looking at, were up or down 10 or 20% for no reason other than 𝗏𝗏𝗏𝗏 had to sell them, which made Citadel have to sell them, which made Millennium have to sell them, which made Renaissance have to sell, you know, and Renaissance did something that was very rare. In the past, when they were at the brink, they didn't override the model. This time they overrode the model. Simon said, cut the positions. And the traders really, the people at the firm, the partners, the traders, everybody, they really didn't want to do it because they knew that if we're cutting the positions, we make the spreads blow out further. Yeah, I don't do any back testing whatsoever. There's an art to it. You could do it, but in this day and age, there's no reason to do it. If you have capital, you just forward test and collect observations and you can go from there. But many people still back test. It's just a matter of doing it the right way. And most people, I would say, it's kind of like a lot of other things in finance. Most people will do themselves more harm back testing than they will do them benefit. So anyway, क़uantMare, eventually Renaissance recovered, but they were down 20 or 30% in like a couple days, maybe a week or two, I forgot. And their precious track record, which, you know, look, I love that firm. Their precious track record could have very well, wait, what just happened to my, they did the impossible. Oh, they did the impossible. I mean, this is a tiny account, so I don't care, but come on. Not all the way, but they cut it in half. I'm not going to close the account because it's always nice to have an account open at every place, but it's funny because when Cassava, if you guys remember, we were like even more frenetic during the Cassava craziness, right? And we were like, everyone said the same thing. They're like, Martin, what happens if they, one, lie Okay, yeah. So I basically like laid out the case. People said, all right, Martin, you're right. You did your homework. You're smart. You have experience. You're proved beyond any doubt that this drug does not work. Okay? The crazy bag holders, they can think what they want, but you laid out the evidence. You wrote it down in a long paper. You're right. But what if they lie about it? And two, yes, what if they delay it, which is, kind of part one. Or even more important, 3 or 2, what if they fail, but the shareholders don't care? The stock goes up anyway. They couldn't lie. That was part of the good part of the trade. But they could have spun. And remember, it's a market. They could have bad results, and it still could have gone up. Right? Like it could have happened that Cassava went up on the failure because of short covering, because of lots of money sloshing around. This is like D-Wave is up, even though their sales backlog is practically drained to zero. Did Springer say he made 500 videos on Cassava? I should make 500 videos on D-Wave. Gibson has gone bankrupt like a million times. Fender's private. I like Gibson, but I love Fender too. There weren't too many guitars in jail, but you could do it. Joseph, I think some of them are doing it, but hedge funds are scared, man. A lot of people are short these stocks, okay? A lot of people are short these stocks. They don't have the tenacity to stay in, so that's why they, people cover them. They go up. Be not afraid is all I have to say, Michael. Be not afraid. Trust your intellect. Trust your instincts. I didn't wake up thinking the stock would be up 53% today, okay? I did not. But am I going to cry about it? Maybe for a minute or two when nobody's looking. But Tilray went up like crazy. I shorted it. It went all the way back down. But the liquidity of the situation is more important than anything else. TTD had a bad quarter last quarter, so I don't know what's going to happen this quarter. Some companies, like Mongo, has had that back and forth, back and forth. Yeah, TTD had that terrible quarter last time. They're doing fine, just fine now. Well, if history's any, well, I don't even know. I remember this day, and I didn't think it was cheap enough to like start buying it again, or to start buying it at that moment. But this is, yeah, guidance looks not great. Big number though. It's similar to 𝗡𝗏, right? In some ways. 𝗡𝗏 had the big beat and the big guidance raise. HIMS had the big beat and the not so great guidance. Same as TTD. HIMS did, had this big weird move on the open. Ah, that's very sweet. As of today, I don't feel like much of a genius, but that's life. All right, guys, I'm going to go work on some stuff.